Hey, what's going on, everybody? This is John Casmon, your host from Multifamily Insights. I'm here with a solo episode, so really excited to chat with you about something that I've been thinking about here for a little bit. I just spoke at the Big Deal Summit out in Columbus with my buddy Mike Ely, talking to investors about analyzing deals and really advanced strategies to analyze deals. And I wanted to share some of those insights with you right here. So, if you're excited, ready to jump on this journey, let's check it out right here on Multifamily Insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. All right. Hey, so listen, John Casmon here, Multifamily Insights. And one of the things that I love is sharing insights on how we approach the business. And I think the most important aspect of this is to understand that it's a mindset. And when we talk about mindset, for me, it's about the growth mindset. It's about always being in an education space, always learning from others. And I mean, whether you have a ton of experience, you're new, I feel like I can always learn a thing or two from anybody. So I just try to be a sponge as much as I can, but also then share what I've learned and how I approach the business to help other people along their journey. So with that in mind, one of the things I want to get into is our approach for underwriting multifamily deals. And before we get into that, I want to tell you, it is way less about the numbers than you think. See, the number one mistake people make when analyzing multifamily deals is only focusing on their returns, the ROI, the projections, the spreadsheet. And listen, a spreadsheet is not an investment. It's not operations. It's not execution. There are no people in your spreadsheet. And the reality is, in the real world, business requires people, people that have emotions, people that have good days, people that have bad days, people who want to make more money, people that want to have a career trajectory, people who lost money, people who are going through a hard time, people who get sick. And that isn't always reflected in our little spreadsheets and our little Excel documents. And most people underwrite deals and they just look for a magic number, whether it be equity multiple, whether it's IRR, which is the internal rate of return, cash on cash, or some other metric that tells them this is a good deal. So, my first tip to you when you're underwriting deals, don't start with the return metrics. You got to start with the main outcome. What do you want to own? Why? How are you going to manage it? What's your buy box? What's your deal criteria? This is the first place to start so you know what you're looking for. Because I can give you any deal. You can change the numbers, you can make the numbers look good. Doesn't mean it's going to work out in the real world. So you have to start with understanding what you are really looking for. So for us, that starts with our deal criteria. We're going to look at the market first and foremost. So, what markets do we like? For me, I'm in Cincinnati. Cincinnati is a very strong market when it comes to multifamily. We have pretty good cash flow, pretty good appreciation potential, solid, population growth and solid metrics across the board. And within a 2-hour radius, we see that in Columbus, see that in Indianapolis, Louisville, Kentucky, Lexington. A lot of these markets are fairly strong when it comes to these metrics. So we like this area. You may be in other areas or other markets where maybe it's better for cash flow, maybe it's better for appreciation. That's up to you. But for us, I'm first and foremost paying attention to the macro market. I want to understand what's going on in that area. Then I'm going to get into the sub market or the micro market to understand what I can expect moving forward. And for me, one of the main things I'm paying attention to is renter desirability, because renters are the ones who are going to be living in your property. See, people often go to population growth and just assume that, hey, if this area is growing, then there's going to be strong renter demand. There's certainly a correlation, but it's not direct. There are markets where you have tech jobs or a lot of high paying jobs, and people move to that region, but they might be homeowners themselves. They're not looking to rent, or if they rent, they're renting houses or luxury class A apartments, not necessarily C class or B class apartments. So this is something you have to factor in. And when I say desirability, I want to be in areas where people actually want to live, not just because it's cheap. I personally don't want to wear a vest to go pick up rent. Not that I go pick up rent either way, anyway, but I don't want to do that. That's just a personal preference. I prefer to have all my stuff online, automated. I prefer to go in areas where there's hardworking people who want to live there, like living there, want to be a part of the community. That's something that's important to me, is to be able to add value to those individuals through our homes and our apartments. And that's something I look for, is areas where people really want to live there. They're moving there. It's aspirational. I think about some of the places where I lived growing up and the places where I wanted to live. Those are the areas where we want to play in. So for us, when I'm looking at our micro markets or I'm looking at our sub markets, I want to look at desirability. I want to be in the path of progress. So this is recognizing the trends. Where are people headed? Is one area getting a little too expensive, seeing a lot of development? Where are those people moving to? Because where they seek value is kind of where I might be able to seek value. And as investors, that's the key, is you want to get just ahead of that curve so you can create the value in your portfolio. Get there right before them, give them something that's desirable. They move in. Over time, that place is going to go up in value, right? So I like those two elements when I'm looking at a market. I'm going to give you a little thing that I absolutely love. When I am looking to invest, I'm also trying to make sure I understand what the outcome is going to be on the exit, meaning how desirable is this property going to be? Is this market going to be for someone else? Because you can get some great deals where the numbers pencil perfectly, but if it's in a really small tertiary market where very few out of market investors are going to look, then you may not have that buyer on the back end. Now, for some people, that's fine. It really comes down to your business plan. But for us, we do plan to sell most of our properties at some point. So we do want to be in areas where we know there's going to be a groundswell of other investors who are going to be looking to buy in that area. All right. Now, let's talk about the actual property. Now that we kind of have our market laid out, let's talk about the property, what I'm looking for. So, we typically we call it B class properties. So, something that's maybe 20, 30, 40 years old. And in these properties, most of the major mechanical work we like to see has been upgraded to current code. So I want to see upgraded plumbing, upgraded electrical, the big ticket items. It doesn't mean we can't do these things. We just have to account for them financially. You don't typically make money because you have a upgrade electric system. Tenants don't look at apartments and say, "Oh, what kind of electric y'all got? What kind of amp wattage you got here?" That's not how people think. Okay, tenants don't pay you more money because you upgraded the electrical. Same with plumbing. No one's walking in and saying, "You got PVC pipes." Oh man, I'll pay you an extra $100 for the PVC pipes. Like, no one lists that on their leasing ads, right? No one lists the plumbing pipes or the electrical or the new roofs. We expect that to work. Okay. I expect my apartment not to leak. I expect the toilet to flush when I push the handle. I expect the lights to turn on, and for when I plug in a curling iron, well, not me, but when people plug in a curling iron or just a regular clothes iron, that it doesn't trigger, the circuit and break it, right? So this is what we expect. We expect things to work the way they're supposed to work. People don't pay a premium for that. That is the expectation. So as investors, if you have to come in and pay to upgrade those things, you're not going to make that back. I guess I should start by saying we do what's called value add investing, where we're looking to buy a property based on how it's performing today. And then we are going to increase the value of that property based on the business plan we are looking to implement. So again, tenants are not going to pay you a premium because you upgraded the electrical. You have to do the touches that they're looking for in order to actually make more money. So as I'm analyzing deals, I really prefer properties where those big ticket items are already updated and we can focus on the things that tenants are going to pay a premium for. So as we get into that, that's typically going to be kitchens, bathrooms, paint, light fixtures, flooring, appliances. Sometimes it could be the layout, but again, that starts to get a little bit pricey. But we're trying to see what can we do to this unit to create value. Now, when I'm underwriting a deal, what I really, really love to see is operational inefficiencies. Because when I see the operational inefficiencies, that tells me there's things that we can control more to create more value. What does that look like? Well, what is the current occupancy? If the occupancy is below 90%, then there's usually something we can do to push that up. In many of my markets, the occupancy in the areas is 94, 95, even 96%. We're seeing that start to shift and go down a little bit across our markets, but typically you're still seeing mid 90s on occupancy. So if you're less than 90% occupancy, there's something you can do just to get more tenants there. So that's one of the things I'm looking for. The turn time. Now, this is a challenge. It's harder to get, those contractors to turn. It may be harder to get maintenance crews to turn, but the turn time, that could be something else that is an operational inefficiency. Could be staffing, could be third party management, could be a lot of different things. You're going through the expenses, you're going through the income, and you're trying to figure out almost like a consultant or a private equity firm. You're trying to take a look at the financials and figure out how you can run it more efficiently. So outside of the renovations, and yes, we're going to go and fix up units and all that, but just looking at the numbers, looking at that T12, right? The trailing 12 months of operations. How can we run this business more efficiently than what it's being run as today? Okay. Sometimes there's a humility component that needs to come in because if I know I'm dealing with a great owner, a great operator, I am not going to make the assumption that I'm going to be able to run it better than that person can. If I know they have really good operations, then I'm going to assume that what they're doing is what it takes to operate. Now, we can still make different choices. We may still get different vendors or have some savings here or have a different vision for the property, but it's a fallacy to just assume that you're going to do better than the current owner, especially if that owner has multiple properties and is a seasoned investor. I can't tell you how many times a new investor, someone who's never bought a property, looks at a property and they just regurgitate what they heard from the broker that the property is being mismanaged and they're going to run it at a 40% expense ratio, even though the current owner is running at a 50% expense ratio. And maybe you can, but the more practical outcome or most practical projection is that you're going to be worse than the person who already owns it, already knows the issues and headaches that are involved in the asset, and is already actively managing that property in the market with teams, with crews, with employees, and understands what's going on at that particular asset. Maybe you can, maybe you can't. It really depends on your market level knowledge, the experience you have. But as you grow as an investor, you'll start to recognize those operational inefficiencies and where you can tighten things up. So I'm always looking for that because those are things we can control a little bit more. We cannot control the cost of lumber. We cannot control, turn contractors as much as we love to. We cannot control certain things that are out of our hands. So I try to focus more on the things we can control. Now, when it gets to the actual underwriting of the deal, now I'm getting into the spreadsheets and I'm trying to put together my idea of a business plan. I like to ask a lot of questions about the story of a deal because I'm trying to understand where the value is, where is the opportunity. And by asking those questions, I can start to know what I'm looking for when I underwrite. Again, most people just sit down, they grab a rent roll, they grab a T12, throw it into a spreadsheet, and just see what the numbers say. And the reason that's a big mistake is you have no idea what you're looking for. You have no idea what levers you can pull to create value. So instead, by understanding the story of the deal, we now know what we can do to create value. If you don't know what you can do to create value before you sit down and start working with the spreadsheet, don't bother, because creating value goes back to being in the real world, not in a spreadsheet. If you look at a business, you look at a property, and you don't know how you can create value, what is the point of putting it into a spreadsheet? Particularly for a value add investor, but even as a long term investor, maybe the value is, hey, it's in a great location. We're just going to hold it 10 years and allow it to appreciate organically over the next decade. That's fine. If you're buying at a number where you like the returns and you can ride it out 10 years, awesome. No problem with that strategy. But if your goal or your intention is to create value, particularly if you're working with other investors and they have a return threshold that you're looking to reach, you got to have a vision of how you create that value. You have to. You just sitting down with a spreadsheet and praying is not going to get it done. It's going to waste a lot of time. So if you don't know what you're looking for, don't even bother underwriting the deal. However, if you have identified where there's opportunities to create value, now we use the underwriting approach to see how much value we can create. See, most of the time, you can renovate the units and you can push rents maybe $100, $150, $200. You just don't know if it's worth it. You don't know how much you should pay for the property and then spend on the renovations and how much the property is going to be worth when you're done with all that. That's where underwriting comes into play. But you have to have a vision of how you create value before you even get started. And if you want to learn more about the approach, I've got a free guide to 7 questions you must ask before investing in apartments. So check that out. You go to casmoncapital.com/7 questions. So now that we know this is a deal, we know there's an opportunity to create value. Now I'm going to jump into some of the main things I look for when I'm underwriting a deal. Okay. One, I'm looking at the rent roll. What is the current occupancy? What is the market rent? And what's really the trend over the last, let's call it 90 days to 6 months? Are rents going up? Are they renewing leases? Are new leases and they call it lease trade outs, right? Where you have one person at a lease, they move out, someone else moves in. How much more money is that person getting in rent? That's what I want to know. What is the increase in the lease trade outs? So that's something I pay attention to. I'm also looking at any discrepancies in the financials, particularly with the expenses, both from a pro forma standpoint, if I'm working with a broker, and then also with my underwriting and what I might know in the market. So is the gas bill crazy high? Maybe the water bill is really high. That may indicate that there's a water leak or something like that. So I'm just trying to see, hey, where are the numbers off? Hey, for every month it was kind of flatter in this range, and then one month it was crazy. What happened there? Right? I'm kind of being a little bit of a detective, right? I'm trying to figure out, what do I need to pay attention to? What challenges may I incur? Like, what do I need to think about, and how would this impact my business plan as a new owner? That's what I'm really evaluating, is I'm trying to figure out the business plan. Does it make sense? Did I miss something? Do I not really know what's going on with this property? What questions do I need to ask? And how do I prevent myself from making a big mistake? Okay. So after I go through that, I'm going to underwrite the deal. I'm going to figure out where I think there's value for me as an investor using my underwriting tool, and then we're going to move forward with our offer, right? But before we do that, I ask myself a few more questions. One is, what could happen that would make this deal go sideways? What did I miss? All right, maybe my underwriting is based on a certain occupancy. So what is that break even number that I need? What's the risk of that? And the reason that question is important is, if you know you're going to break even, let's say 70% occupancy, but anything underneath 70% occupancy, you're upside down. Well, that's important to know. You want to make sure you can stay above 70%. And that may change the business plan depending on what you're doing. When I had a 28-unit property in Cincinnati, the plan was to keep the property filled and just slowly renovate over time, take out one unit, fix up the unit, and then, bring in a new resident. Well, the reality was the new residents didn't stay because they didn't like their neighbors. The neighbors just, the community needed more work to turn it over and get it to a place where people really wanted to be there. And it was really a mixed match of the old residents who were there and the new residents we were bringing in, and they did not mesh. The new residents were more professionals. The older residents, were not. And I mean, we had new residents move in and they were moving out after 6 weeks, 8 weeks, sometimes a month. And we realized very quickly we could not move forward with the business plan we had. We ended up having to move out a lot of residents in order to turn the community over. But I did not underwrite with a 25% occupancy strategy. So we ended up having to front pretty much most of the bills because the property didn't have enough cash flow coming through to cover it. So again, we're underwriting these deals. That's something that, doesn't show up in the numbers. Why? Because we deal with people and people make people choices. And if your neighbors are partying or throwing trash over the balcony and just loud and not, courteous, you may decide you're not living here. You're breaking the lease, forget it, move out and go. And that doesn't show up in the spreadsheet. So you have to have the human factor in mind when you're analyzing these deals and thinking through the business plan and recognizing what tension there may be in your plan and how do you pivot, how do you adjust. If this happens, what do you do? And that's what makes underwriting challenging for a lot of people. It also is what makes it creative and it could be fun if you think about it from the lens of creating the business plan to drive success and to build a strong, successful community. And that is why I don't go straight to the spreadsheet when we talk about analyzing deals, because I don't think it's about the numbers as much as it is about the community, the impact, the vision, what you're trying to create. And then, yes, let's understand the pro forma, the projections, the financials, and the numbers because it's important. Obviously, we're trying to make money here, but all of that is rooted on assumptions that are based on people. And if we don't understand the people and the assumptions and the community we're trying to create, the investments we're trying to make, all of it falls apart. It's all built on, false assumptions and it's not worth anything. So I come back to what are we trying to create? What is it going to take to create that? Then you can get into the budget of that. Okay, can we do it for this budget? How can we be more efficient? What if we did it this way? But it doesn't change the outcome. You're still looking to, maybe improve the quality of the community. You're still looking to, renovate units. You're still looking to do some of the same things. You're just now changing how you approach it and understanding the different levers. Maybe you don't have to put granite countertops in there. Maybe you use a different finish, right? And you save $5 a square foot or whatever the case may be. You can go through and figure out those kind of things with the budget and your underwriting, but you first have to have an actual vision of what in the hell you're actually trying to do, right? So that's the important thing is just having that clarity of what are we trying to create? What is it going to take to create it? And then can I do this in a manner where it's profitable for myself, for investors, and all of the key stakeholders involved? I've got a couple of metrics that I pay attention to. We certainly use IRR. It's a strong metric that most investors, especially syndicators, most syndicators use. But I also like to pay a lot of attention to the stabilized cash on cash. I also like to look at, a couple other metrics that are a little more niche and maybe a little bit more sophisticated, but they just help me understand one opportunity compared to another opportunity where maybe on paper the deals look very different. So have your way of just navigating deals, investment opportunities, set your return expectations, understand what investors are looking for if you're working with investors. But ultimately, to me, it comes down to getting real clear on the kind of properties, the kind of investments and business plans you want to make. Are you in the right locations? What is the actual business plan you're looking to execute? And do you have the vision on the back end? The last thing I'll say is always think about the exit. We spend so much time underwriting deals. And I mentioned IRR, which is the internal rate of return. It measures the time value of money on your return, right? So you can invest, let's call it $100,000, and over 5 years, you can make $100,000 return. But if you didn't see that $100,000 until the end of 5 years, it's still, it's still a 20% return. It's still a 2x on the equity multiple versus if you got 20,000 every year for 5 years back, and that initial $100,000 at the end. Getting those $20,000 each year is probably more valuable to most people because they could go reinvest that. So the IRR factors in the time value of you getting that money a little bit faster than if you only got it at the back end. That's a great metric, but the flaw in the IRR is we're still making an assumption of what we're going to sell it at on the back end. And I think that for the current environment, we've seen a lot of deals where folks made some assumptions that have not panned out to be true. So we tend to place a little bit more value on in place metrics, stabilized return metrics, on things that we maybe have a little bit more control over. We can't control cap rates. We have no idea where interest rates are going to be, 6 weeks from now, yet alone 6 years from now. So for us, it's more about controlling the controllables and understanding the stabilized cash on cash return, stabilized cash flow, and ultimately what we can control as investors. So as you're looking at deals, when you're looking at your underwriting models, ultimately you want to make sure you're focusing on deals that you believe in based on the market story, based on the property story itself, the age of the asset, the business plan that you can employ, and then also your exit strategies. You want to build communities, figure out what your options are, but who's going to buy this property from you when you're done? What are they looking for? Having that in mind is going to make it a little bit easier to make certain decisions. I know some investors love to leave a little meat on the bone, as they say, for the next guy. Some people want to renovate 100% of the units and stabilize it. The answer is it comes down to who do you think is going to buy the property from you? Do they want it 100% stabilized or do they want a little meat on the bone? Is it another syndicator? Is it someone else who's going to, need to create value? Is it somebody that wants to just have a, coupon clipper where it's just putting passive income in their bank account every month? It depends. Okay. Your business plan, it's always going to depend. And one of the reasons we coach and work with people is there's so many variables that it's damn near impossible to just tell you, hey, here's how to invest. There's a question at every stage. And it helps to have the right person in your corner to bounce these questions off of, to help you think about the business so that you're asking yourself the right questions. So ultimately you can decide what kind of investment you want and whether or not that investment is the right deal for you. Again, we love doing these solo episodes, sometimes a little bit tricky, but hopefully you got some good value from this conversation today. If you did, please share this episode with somebody who you think would enjoy it and make sure you leave a rating and review on the show. It helps us tremendously to connect with other investors. Until next time, it's John Casmon here on Multifamily Insights. Take care.